Bitcoin investors are watching the charts panic, but something much bigger is happening behind the scenes. While billions are leaving crypto markets, the world's largest financial institutions are quietly preparing a system that could change how Bitcoin is bought forever. In this video, we'll uncover the hidden shift happening in Bitcoin ETFs, retirement funds, and institutional strategies, and why this could become the biggest turning point for crypto's future. Billions are leaving Bitcoin ETFs. Sentiment has turned brutal, and everyone thinks the opportunity is gone. But the world's largest asset managers are building something nobody is watching. Bitcoin is falling, investors are fearful, and the market looks broken. But behind the chaos, something much bigger is quietly happening. Lewis reveals that while traders are focused on Bitcoin's decline, some of the world's largest financial institutions are building the next generation of crypto investment products. The current market shows extreme weakness, with heavy ETF outflows and declining confidence among investors. But this downer may be revealing a different story. Institutions are not walking away from Bitcoin. They are preparing for deeper integration. Lewis highlights Franklin Templeton's strategy, which combines traditional U.S. equities with Bitcoin exposure. Instead of requiring investors to constantly buy Bitcoin themselves, the fund uses dividend flows to gradually increase crypto exposure, creating a more automated accumulation model. Then comes BlackRock's approach, which takes a completely different path. Rather than chasing only Bitcoin's price growth, its strategy focuses on generating income through covered call options while maintaining exposure to Bitcoin's potential upside. The key takeaway from Lewis's analysis is that Bitcoin's current volatility is happening alongside a major financial transformation. Regulatory changes have made crypto ETF launches faster and easier, opening the door for more institutional products. While the market is focused on today's price, the bigger battle is being built behind the scenes, the race to make Bitcoin a permanent part of global finance. What do you think this institutional Bitcoin shift means for the next crypto cycle? Share your thoughts in the comments, share this video with others, and subscribe for more deep market analysis.
Strange. Bitcoin is sitting at roughly $59,500 as I record this, down about 52% from its October all-time high of $124,720. The 14-day RSI is parked at 31, knocking on the door of oversold. The Fear and Greed Index just printed 13, deep in extreme fear. US spot Bitcoin ETFs have bled out around $6.35 billion over 7 brutal weeks, with a single day in late June seeing nearly $692 million walk out the door. Total spot ETF assets have collapsed from roughly $170 billion at the peak to about $73 billion today. This is not sunshine and rainbows out there. This is a cold, risk-off, capitulating market. And it's against exactly that backdrop that the deepest pools of capital on Earth decided to start building permanent BTC buying infrastructure. Which brings us directly to what Franklin Templeton. Here's Franklin's twist. There are two funds, the Franklin US Equity Bitcoin Drip Index ETF and the innovation-focused version, hold a normal basket of US stocks. The broad fund tracks a VettaFi index of nearly 500 large-cap US companies. But instead of reinvesting the dividends back into those stocks, it takes that cash and buys Bitcoin exposure instead. The mechanics are deliberate. The index starts at 95% stocks and only 5% Bitcoin. When BTC drifts up past that line, it rebalances back towards 4.5% on a quarterly basis. There's a hard 20% cap, and the Bitcoin exposure is accessed through a mix of spot Bitcoin ETFs like Franklin's own EZBC, CME futures, and listed options, embedded right inside the fund itself, rather than through a separate subsidiary. Filed under 485 APOS, BlackRock went live with something completely different, the iShares Bitcoin Premium Income ETF, ticker BETA, launched on June 16th. This one isn't about accumulation, it's about yield. It holds spot Bitcoin and shares of BlackRock's own IBIT. Then it sells call options on roughly 25% to 35% of those holdings. For those unfamiliar, a covered call is simpler than it sounds. Put simply, you rent out the future upside on an asset you own in exchange for cash today. Beta hands that cash to investors as monthly income, targeting a chunky 15 to 25% annualized yield, while aiming to keep around 70% of Bitcoin's price moves. The fee is 0.65%. So look at what's happening here side by side. Franklin built a tool for the investor who wants to accumulate BTC without thinking. BlackRock built one for the investor who wants income instead of upside. And that's the pattern, not the exception. Back in December, Bitwise's Matt Hogan predicted what he called an ETF palooza in crypto land, forecasting over 100 new crypto ETFs and ETPs rolling out this year. Bloomberg's own James Seifert described issuers as throwing a lot of product at the wall. So, how did the floodgates open so fast? That brings us to the deeper layer, the boring regulatory switch that made all of this trivial. In September 2025, the SEC approved generic listing standards for crypto ETPs across the major exchanges. Before this, every new crypto fund needed its own bespoke rule change filing, a gauntlet that could take up to 240 days. After it, qualifying products just slot into a roughly 75-day review. That single rule change turned the approval process from a one-off battle into a conveyor belt. Franklin's September 1st target date is driven entirely by the 75-day clock ticking.
What if the next Bitcoin rally isn't powered by crypto investors, but by the trillions of dollars sitting quietly in retirement accounts? Could retirement money become the biggest force behind Bitcoin's next major move? Lewis reveals a powerful possibility. The world's largest pool of capital may soon have a new pathway into crypto. U.S. retirement assets are estimated at around $47.6 trillion, with trillions sitting inside equity-focused IRAs and 401k accounts. But what happens if even a small percentage of that money starts flowing into Bitcoin? Lewis highlights that a 1% allocation could represent nearly $476 billion in potential demand, while a 5% allocation could create a multi-trillion-dollar buying force. But is this the beginning of a new Bitcoin era, or are investors ignoring hidden risks? Lewis points out the biggest concerns. These products may carry multiple layers of fees that could reduce long-term returns. More importantly, automated Bitcoin buying systems do not analyze whether Bitcoin is undervalued or overpriced. They continue purchasing regardless of market conditions. And there's another warning sign. History shows that a flood of new crypto products can sometimes appear near market tops. So, are institutions building Bitcoin's future foundation, or are they creating the next speculative wave? The answer could determine where Bitcoin heads in the next cycle.
Telling the panic. The average BlackRock IBIT investor is now sitting on a roughly 40% loss, which ETF Store's Nate Garassi called a, quote, brutal introduction to Bitcoin. The Coinbase Premium Index has been negative for 46 straight days, the longest streak on record, a genuine warning of institutional buyers staying home. And yet, into that exact fear, the biggest names in finance are laying the pipe for automated buying that runs for the next decade. Here's the structural insight that matters. Drip-style products create price-insensitive, recurring demand. Vetify's Ryan Schlosser described the Franklin structure as a programmatic dollar-cost averaging tool. The dividends get paid on a fixed calendar, regardless of the headlines, regardless of the fear and greed index, regardless of whether BTC is at 124,000 or 59,000. That broad fund's underlying index yields around 1.05% a year, which means it mechanically converts roughly 1% of assets into Bitcoin annually on autopilot. Compare that to what's exiting right now. Dutch Bank's Marian Labor points out that Bitcoin's price is increasingly set by fund flows, and the current outflows prove ETFs are being used as high beta risk-on tools, dumped the second macro gets scared $47.6 trillion as of the most recent data. Roughly $7.5 trillion of that is in equity-focused IRAs and 401ks, exactly the dividend-paying pools these products are designed to plug into. BlackRock itself has floated a, quote, modest 1% to 2% Bitcoin allocation as a portfolio diversifier. Even 1% of the total retirement pile is roughly $476 billion, a demand channel that dwarfs the entire current ETF market. A 5% sleeve gets you to around 2.4 trillion. That is a buyer that simply did not exist a year ago. But it would be dishonest of me to leave it there, because the skeptics have a case that's just as big. So let me give you the honest counterweight. First, the fees on fees. A Franklin drip investor pays the fund's management fee, then pays the cost of whatever Bitcoin instrument it buys underneath, then eats the trading and options overhead stacked on top. For context, Franklin's own spot BTC fund charges 0.19%, and a plain S&P 500 index runs around 0.03%. Stack 3 layers of cost on a 30-year retirement horizon, and that drag compounds into a serious hole. Second, the valuation problem. Classic drip has a built-in stabilizer. When a stock falls, your dividend buys more shares cheaply. But this mechanism buys Bitcoin not because BTC got cheaper, it buys because some unrelated US company paid a dividend. It has no valuation filter whatsoever. At today's price, that looks disciplined, but the identical machine would have been buying at the $124,720 top with exactly the same enthusiasm. Is that accumulation or just mechanical buying at any price? Third, the froth signal. Historically, a flood of new crypto products marks the top, not the bottom. ProShares BITO Futures ETF launched on October 19, 2021, roughly 3 weeks before that cycle's peak of around $69,000 on November 10th. A wave of 100-plus filings can look an awful lot like Wall Street productizing a hot asset right before it cools. But here's the counter.
Bitcoin may be entering a battle that decides its future. Will trillions of dollars from traditional finance create the next massive crypto expansion? Or are investors overlooking the risks hidden beneath the excitement? The rise of institutional Bitcoin products, automated buying systems, and potential retirement fund exposure could transform how capital flows into crypto markets. But is this creating sustainable demand, or simply building another wave of speculation? The answer depends on one critical factor: whether institutions are bringing long-term conviction or just chasing the next financial trend. As Wall Street moves deeper into digital assets, Bitcoin is no longer only a technology experiment. It is becoming a test of adoption, valuation, and investor confidence. The next market cycle may not be decided by hype, but by how this new financial infrastructure performs when real pressure arrives. So the biggest question remains: are institutions building Bitcoin's future, or are we witnessing another market cycle driven by hype? Let us know your thoughts in the comments. Share this analysis with others, and subscribe for more Deep Sea.